Welcome to your virtual CFO coach. I'm your host, Leah Torbert, founder and CEO of Harrington Strategic Partners. I've spent my entire career working in the startup world, scaling businesses to multi-7 and 8 figures. I built this podcast to share all of that knowledge with you and make your path to success shorter and easier. Tune in each week as I cover topics including financial analysis, cash flow management, holistic strategy, mindset, and more. Now for today's episode. Today, I want to dive into a topic that a lot of people probably don't even think about, but is extremely important in understanding how the financial transactions process in a business, and that is which accounting method you're using. So there are two accounting methods. The first one is the cash method, and the second is the accrual. The difference between these two can have significant impacts in how you're reading your financials and how you're managing your tax burdens throughout the year. So it's really important to understand the differences between the two and what you can do to maximize things in your business. So I want to dive into what they are, how they're different, and then how that data can then affect your business decisions. All right, so number one, what is the cash method? The cash method of accounting is the easiest of the two. Your revenue is recorded when you're paid. Your expenses are recorded when you pay them. It's like looking at your bank statement. Your bank doesn't care when your customer promised to pay you. It simply tracks when the funds were deposited. Similarly, your bank doesn't care how long you owed your vendor money. It simply tracks when the payments cleared the bank. So we're looking at when did the cash come in and what was it for? And then when did the cash go out and what was it for? That's it. Pretty simple, right? So why the need for accrual? Using the cash method leaves out quite a bit of information that can be useful when trying to figure out if your revenue is growing, how effectively you're using your cash, and what your actual monthly operating expenses are. For example, if you buy 12 months worth of liability insurance at one time, the cash method records all of that in the month you paid for it. It was cash out after all. Or if you pay your electricity bill late, you could see 2 payments in one month and none in the other month. On the revenue side, your P&L will show the increase or decrease in payments received, but not whether you actually sold more or less. Now, there are ways to adjust some of this data depending on your system and how you're entering the transactions. Many systems have the option to toggle back and forth between accrual and cash methods so you can see both sides, but the accuracy of that data still depends on how it was entered into the system. So before we're diving into that, let's talk about the accrual method. So what's the accrual method? The accrual method of accounting aims to record transactions in the period that they occurred, regardless of when cash was exchanged. So what does this look like in practice? Sales are recorded on the day services were rendered, not when you were paid for them. When you look at your P&L, you can easily see if you sold more this month versus last month. The flip side of that is if your customer pays in advance of service, you don't book it as revenue yet. Those funds are technically a liability because you would owe the money back if you can't meet your obligation to the customer. So you still have to be careful where you're posting the money based off of what it is for when it's coming in. Timing is still very important there. If you receive a bill from a vendor, the bill gets entered on the date of the bill, not when you pay for it. So if you're purchasing that 12-month subscription, the total amount is split up over 12 months, not recorded all on the month that it was purchased. So what this does, when properly maintained, is to easily let you see whether sales are up or down, if your expenses seem higher or lower than usual, and how much money people owe you, and vice versa. And then you can start diving into managing your collections and payables processes to tweak your cash flow. So now you have the basics of what cash and accrual method are. So can you do both? For consistency, you need to decide which method will be used in your accounting system. You can't record using the cash method in January and then change your mind in February. Most new businesses start out using the cash method and may choose to convert to accrual at the beginning of a new fiscal year if the needs of the business will be better met under accrual. Sometimes invoices and vendor bills are tracked in a completely different system, so you can have visibility and manage collections and payments, but the accounting system is managed under the cash method. Or accounts receivable may not be needed, but vendor bills are entered in AP for tracking purposes and paid on a schedule. So you have some flexibility depending on the different systems that you have available for your business, for your industry, and where you are in your current phase. In a system like QuickBooks, you can put your AR and your AP in the system, and then you can change your accounting method for the report from accrual to cash or vice versa, and then you can see the differences in your reports. Also, sometimes business owners choose to record their transactions on an accrual basis because they like the reporting, because you get more information and you can see how your business is growing. But they choose to file their tax return on a cash basis because they meet the requirements to do so, and it's more advantageous for them from a tax perspective. We'll talk about that a little bit more in a bit. So you might be asking yourself, after hearing the difference between the two, should you be on accrual if you're not already? And the short answer is it depends on your business. If your business mostly or always accepts payments at time of service and your expenses are pretty regular, then converting to accrual may not make much of a difference for you. If you have a lot of customers or vendors to manage on payment terms, then converting to accrual could provide better data to help you manage your cash flow better. Something else to keep in mind is there could be outside forces that affect this decision. For example, the IRS has guidelines for how to determine if you can file your tax returns on a cash basis. If you don't meet that requirement, then you'd have to use the accrual method. Another situation that could require you to change to accrual is financing. If you want to pursue a loan or line of credit for your business, one of the requirements may be to report on an accrual basis. So start with these questions. Number 1, is there an external reason why using the accrual method is necessary? For example, banking or IRS regulation. Number 2, if not, what benefits could you gain from switching to accrual if you're currently on the cash method? So what level of reporting could you do? What additional information could you get out of the data that would make you be able to make better decisions? And then number 3, do you have systems in place that could provide what you need without changing your accounting method? So remember, I mentioned earlier, sometimes there are separate systems set up that are already maintaining invoicing and payments and collections and things like that. If you do have those in place already, are they working well enough that you want to move forward with them as is? Or do you want to consider integrating them into your accounting system by converting to accrual, if that makes more sense for your business? And if streamlining those two systems into one can get you more efficiency and better visibility on your data. So regardless of which system you're in, how do you use your accounting method to your advantage? Since the cash and accrual methods record income and expenses at different times, your taxable income will not be the same under both methods. So what does this mean? Let's say you had $100,000 in revenue and a total of $80,000 in expenses for the year. Under the accrual method, your taxable income would be $20,000. It's simple, 100 minus 80. For the cash method, you have to ask a couple more questions. How much revenue did you collect for the year? And how much did you pay in expenses for the year? If you collected $80,000 in revenue and you paid $75,000 in expenses, then your taxable income is only $5,000. So under accrual, we were at 20. Under cash, we're at 5. Your total revenue and expenses didn't change, but the timing of the transactions can make a big difference between the two methods, depending on your business model and the accounting method you're using. Remember earlier when I mentioned that some businesses use the accrual method for their accounting but choose to report their taxes under the cash method? This is why. The difference in taxable income can be significant. But you have to keep one thing in mind. Not all businesses are allowed to report their tax returns on the cash method. The IRS has requirements for what kinds of businesses can file under the cash method. So if you are interested in learning more about this topic, consult with your CPA. Something else to keep in mind, regardless of which method you're using, is that you can still use timing to your advantage at the end of your fiscal year. For example, under the accrual method, you could choose to ship an order on January 1st instead of December 31st to change the tax year that the revenue would be counted in, assuming a December 31st fiscal year end. Under the cash method, if you have the funds available, you could choose to pay bills that were due in January early in December to book the expenses in the current tax year, assuming a December 31st fiscal year end. So choosing the timing of when you're booking your revenue and when you're booking your expenses, you do have some flexibility there that can be used at the end of the year to try to look at managing your cash flow and managing your tax outlay for the year when you're looking at shipping orders, paying your bills, communicating with your customers and vendors about all the timing of those things to try to manage your cash flow in the best way. Strategies like these can be very effective in managing your cash flow and understanding at a deeper level how to maximize your potential. It's not just boring accounting stuff that us bean counters like to talk about. So I know we've covered a lot here today, just basics of cash versus accrual, some of the timing differences, some of the tax impacts that these decisions can have. And if you're really interested in talking more about how to maximize this in your business, please reach out, give me a call. My firm can help with getting systems and processes in place, with analyzing what's going on in your business, and helping you just in general have a more streamlined accounting system in place to be able to do these things. So if you're interested in learning more, I'll have a link down in the show notes. You can go straight to my calendar, book a time, and let's talk and just see what we can do together. Thanks for listening to today's podcast. If you enjoyed what you heard today, please share with your network and leave a review so our podcast can have a greater impact. If you have any comments or additional topics you'd like discussed on the show, let me know. Before you go, connect with me on LinkedIn and let's keep the conversation going.